Welcome back to another episode where we dive deep into the world of financial literacy and the psychology of the markets. Today, we are going to explore the hidden reality behind the charts, moving beyond the simple lines and candles to understand the mind of one of the true legends in the trading world, Dr. Alexander Elder. If you're ready, we are going to embark on a journey that looks at the market not as a mathematician would, but through the precise and observant lens of a medical doctor and psychiatrist. What separates Alexander Elder from the thousands of other analysts across the globe is one very fundamental, life-changing fact. He is a trained psychiatrist. Because of this background, Elder doesn't see a price chart as just a collection of mathematical data points or random movements. To him, every single chart is an instantaneous X-ray of human emotion, a snapshot of the fear, greed, hope, and panic felt by thousands of people simultaneously. Elder teaches us, above all else, that technical analysis is never a tool for predicting the future. If someone tells you that a chart is definitely going to hit a certain price, they haven't yet grasped the inherent chaos of the marketplace. For Elder, technical analysis is a method of probability management and mass behavioral analysis. Prices move because people assign value to things. Therefore, charts don't show the price itself. They show the collective mindset of the crowds creating that price. For a professional trader, the decision-making process doesn't begin when an indicator gives a random buy signal. It begins when specific psychological and technical conditions align with perfect discipline. To achieve this perfect alignment, we must focus on Elder's greatest secret, the time frame hierarchy. This is the heart of his famous triple screen system. The biggest mistake most amateur traders make is getting trapped in a single time frame and losing their perspective. Someone looking at a 5-minute chart to open a trade is essentially looking at a tiny ripple in the ocean, completely unaware of the massive tsunami wave approaching from behind. Elder solves this problem by establishing an unshakable hierarchy. He tells us that before making any decision on a lower time frame, you must first choose your strategic side on a higher time frame. Think of this like a military operation. The high time frame is the map used by the generals. It determines the strategic direction and the main front of the battle. The intermediate time frame is the tactic used by the officers on the ground. It's where you filter out opportunities and traps. The low time frame is the moment the soldier pulls the trigger. Pure timing. If the main trend on the 1-hour chart is down, every buy signal you see on the 5-minute chart is likely a trap designed to lure you in. Elder's golden rule can truly save your trading career. If the direction on the higher time frame isn't clear, looking at a lower time frame is just a waste of time and a way to drain your capital. This approach is the only way to save yourself from contradictory signals and the destructive habit of overtrading. As we move into the phase of defining and analyzing the trend, we see Elder approaching the market like a meticulous surgeon. He doesn't simplify a trend as just price moving up. To him, a real trend occurs when price and momentum flow strongly in the same direction. Imagine a car climbing a steep hill. The car might still be moving upward, but if the driver has taken their foot off the gas, the end of that climb is very near. Elder measures this momentum using the MACD histogram, but he uses it differently than most. His big trade secret is that he doesn't care about the classic crossover signals that everyone else follows. Instead, he focuses on the slope of the histogram, whether the bars are getting taller or shorter compared to the previous one. When the histogram bars start to shorten, even if the price is making new highs, Elder knows the energy of the trend is dying and the buyers are exhausted. This is where Elder's sharpest weapon comes into play. Divergence. If the price makes a new high but the MACD histogram makes a lower high, it is technical proof that the market is running out of breath. However, even here, Elder separates himself from the emotional amateurs. He doesn't see a divergence and immediately shout, "It's going to crash," and jump into a short position. He treats it as an early warning system. He protects his current profits, moves his stop-loss levels closer, and stops taking new long positions. He knows that a weakening trend doesn't always mean an immediate collapse. It simply means the risk has increased significantly. A professional knows when to stop being aggressive and when to start being defensive. To truly understand the complex nature of the market, we must memorize Elder's manic-depressive market model. The market is sometimes so euphoric that it pushes prices to irrational levels, and sometimes it is so hopeless that it drops prices far below their actual value. Elder uses moving average envelopes to identify these extremes where the market has strayed too far from balance. When price moves outside these envelopes, it shows the market is having a psychological episode. But his core philosophy remains. The market always returns to its true value, its mean, eventually. While catching this return is tempting, Elder never fights the trend without confirmation from momentum. His mastery lies not just in doing the right analysis, but in patiently waiting for the market to confirm that analysis. Many people know the technical tools, but very few can practice Elder's art of not trading. He has a famous saying, "A good trade should scream at you from the screen." If you are looking at a chart and wondering if there is an opportunity, or trying to force a setup, then there is no trade for you there. For Elder, any chart that is unclear or full of doubt is just confusing noise that should be ignored. Now we arrive at the most vital, and often most painful, part of the trading world: risk management. Anyone with a bit of intelligence can learn technical analysis, but risk management is a matter of character and discipline. Elder has two non-negotiable rules that form the backbone of his entire system. The first is the famous 2% rule. According to this, the maximum amount you can lose on any single trade can never exceed 2% of your total account equity. Please listen carefully. This isn't about the size of your position, but the actual money that will disappear from your account if you hit your stop loss. The second rule is the 6% rule, which defines the boundaries of professionalism. If your total losses in a single month reach 6% of your capital, you shut down your terminal completely and do not open another trade for the rest of that month. This rule was created to stop the revenge trading spiral that destroys so many accounts. Elder says, the market will be here tomorrow and it will be here next year. The real question is whether you will still have the capital to sit at the table when that day comes. Defining your position size based on mathematical rules rather than your feelings is what separates a professional from a gambler. Alongside this, Elder's invisible but most effective weapon is the trading journal. To Elder, a trader who doesn't keep records is like a driver speeding down a dark road with the headlights off. In his journal, he writes down not just how much he made or lost, but the emotions he felt while opening the trade, the atmosphere of the market at that moment, and exactly why he exited. Over time, these records create the trader's equity curve. Elder analyzes this curve like a doctor. Is my strategy failing to adapt to the market, or am I losing my discipline and breaking my own rules? If your equity curve is swinging wildly, the problem isn't your system, it's your psychological management. With his psychiatrist's hat on, Elder notes that most traders actually sabotage themselves without realizing it. Trading, in his world, is first and foremost a process of deep self-analysis and knowing who you truly are. To wrap everything up, the formula for Alexander Elder's success isn't hidden in complex algorithms or secret indicators that nobody else knows. His success is built on using a few high-quality tools, an unshakable discipline across multiple timeframes, a rational view focused on momentum, and a risk management system completely stripped of ego. Elder doesn't try to beat the market. He tries to beat the impatient, greedy, and fearful human inside himself. Remember, in this business, the big rewards don't go to the ones who make the best predictions. They go to the ones who make the fewest mistakes and manage to stay at the table during the storms. As we end this episode, keep this one thought in your mind. Alexander Elder's biggest secret is seeing the market not as an enemy, but as a giant teacher that has rules but no emotions. If you break the rules, this teacher will give you a very expensive lesson. If you stay disciplined and patient, the market will open the doors to a level of freedom you've only imagined. The next time you look at your screen, try to feel the breath, the fear, and the excitement of the people behind those candles. Don't bend your 2% rule even for a second. Stay loyal to your higher time frame, and never, ever rush. Because, as Elder says, the best trade will eventually scream, "Come and get me." Wait patiently for that moment. Elder's path isn't for those dreaming of getting rich overnight. It's for those who want to remain professional and consistent for a lifetime. Thank you for listening. Stay disciplined, and I look forward to seeing you in our next session.